Hey guys, hopefully you guys are having a great time with what's going on with the economy. And I just want to give you guys a quick video in regards to with all the student loan stuff, what are some options in getting rid of some of your debt, as well as consolidate them in a way to make your payments. I know I have a lot of clients who are reaching out in regards to like Navy Federal and all their banks to kind of see what are their options for debt consolidation. And, it depends on the situation, and sometimes it does work out. So one of the two main uh, options that you guys have as a homeowner and having equity of your home is that you can use this as a way to consolidate your debt. I did a video like this a couple months ago, and I had a few clients actually reach out to me in regards to looking at what that would look like. Now, refinance for a better rate, probably not going to happen. Obviously, rates are in high sevens at this point, low eights. So if you're refinancing just for a better rate, it's not going to go well. If anything, honestly, we wouldn't even be able to do it because your payment's going to go up so high, and there's really no benefit if that's your sole reason. Now, the one time a cash out refinance or even a refinance in general that would make sense to you is if you have about $80,000 to $90,000 or more to consolidate, and even with a higher rate, that actually would save you some money, if not a lot of money. Now, if you can qualify for it and you have enough equity, a home equity line of credit is a great example. I have one. It was a great way to use as a way to pay for a lot of renovations. You can use that way to consolidate debt. And what a HELOC is essentially it takes a portion of your equity and turns it into a line of credit, like a credit card, and you use it like a credit card. Your payments based on the monthly pay is based on your balance. Sure, the rate is a little bit higher typically, but your payment is pretty low in comparison to what you're most likely paying now on your current credit card. So that's another way to consolidate debt, and usually that's probably the way to go. Sure, the rates are higher, but for the amount that you're borrowing is a lot lower. So it could make sense. I'd be happy to obviously have a one-on-one conversation with you. So just feel free to reach out to me and to see which one's the best option. For a lot of clients, they can't qualify for a home equity line of credit due to credit, or maybe they just have a lot of debt and it's not going to work out. So the other option is something called a cash out refinance. A cash out refinance is effectively you taking a bigger loan, obviously within the equity of your home, that pays off the small mortgage, and the rest goes into your pocket. In this specific context, it's going to pay off all of your debt. So I had a client that actually did this a couple months ago, and then I have a current client now that's looking to this now, and this is the scenario, right? Let me share my screen real quick with you guys, and this is a scenario. So right now they own a house that's worth around $745,000 that they bought for about so they bought it for about $524,000. Now the house is worth $745,000. Currently, they owe $488,000, and they're in a rate of 2.75%, so 2.75. So we ran the scenarios to see what it would look like to refinance $150,000 with the consumer debts on a rate that's about 7.4%. So 7.375 to be specific. Now that rate is literally 3 times higher. So, or 2 to 3 times higher. So does this make sense? That's the key thing. Does it make sense? So before we even went into it, we did what's called a kind of a refinance pre-approval to see what it would look like structured and see if the numbers make sense. So we took all of their debts, right, and figured out that if we got, we can only use so much of the equity, but if we consolidated all the big debts, about $150,000. I think we're consolidating about $149,000. That's the number that we're trying to figure out. So one of the things that we look at is what's the existing? What does it look like right now? So with everything that they're paying right now, with property taxes, home insurance, their mortgage payment, their current and more loan debts, and the credit card debts on a monthly payment scale, what does that look like? And they're paying about $6,600 a month, a little over that. So that's a lot of money that goes toward just that money, right? Well, we figured out if we refinance and put as much of that into the refinance, their payment will go from 66 to about $5,300, which would save them about $1,400 a month. That's a lot of money, guys. $1,400 a month. What can you do with an extra $1,000 to $1,400 a month? It's a lot of money. That's at least a trip to Disneyland once a year, at least, right? So with consolidating all that debt, they would save about $1,400. Now the cool thing is that, let's say they put that extra savings into the mortgage. Maybe they kept that debt payments at $6,600. They would knock off about 10 years off their loan. Now you don't have to do that. You can probably put in, let's say, take $500 of that savings, and they would save 3 years, which they bought the house about 3 to 4 years ago. So they would be on the same track to paying off their mortgage payment as they are now by just taking $500 of that, which leaves you a little under $900 left. It's still a lot of money. So if you are in this, and here's where a cash out refinance does make sense. If you have over $80,000 to $90,000 or more in consumer or debts to pay off. And the reason why this is bringing up now is because student loan debts or payments are now in effect, right? So you can't defer them effectively anymore. So if you're in a situation where with current student loan debts and all the things that you pay for on your credit report, it's over $80,000, $90,000, feel free to give me a call and let's see if these numbers make sense to put you in a better cash flow position, because this is a lot of money that can go toward a lot of things. For this specific client, she's getting out of the military in the next year and a half. Would she like to start saving about $1,400 a month to start with it so that her transition is a lot easier, at least financially? Probably. So don't be afraid to reach out. It'll hurt you more if you don't know. I can tell you that. If at least we explored it, we can always do what's called a soft credit pull, where it doesn't do a hard ding on your credit. Anyway, that's all I wanted to leave you guys with. Hopefully this gives you some insight, some ideas on what you can do with your house to put yourself in a better financial position. Otherwise, that's all I got for you guys. I'll talk to you guys soon.